Hey everyone, Brian here, ready to dive into the exciting world of crypto trading. Today, let's unlock your secret weapon in crypto, a tool that can dramatically improve your trading strategy and give you a significant edge in the market. I'm talking about candlestick charts. These aren't just pretty pictures, they're powerful visual representations of price movements. Forget those basic line graphs. They're like reading a children's book when you need a detailed financial report. They only show closing prices, missing all the action, all the volatility, and all the potential opportunities that happen within a trading period. Candlestick charts reveal the full story. They paint a much more complete picture of what's happening with a particular cryptocurrency. Highs, lows, opens, closes, every single data point is crucial for understanding market dynamics. It's where you see the real market drama unfold, the battles between buyers and sellers playing out in real time. Imagine Bitcoin goes from $70K to $71K in a day. A line chart shows the start and end, a simple upward tick, but not if it spiked to $73K, giving you a false sense of stability, or crashed to $69K in between, potentially misleading you about the true risk involved. That's the power of candlesticks. They reveal the hidden stories within the price movements. They show volatility, sentiment, and momentum, giving you a much deeper understanding of the market forces at play. Learning to read these charts is essential for any serious crypto trader. It's like learning the rules before playing a sport. You wouldn't step onto the field without knowing the basics, would you? They're the language of the market, a visual code that communicates the intentions of buyers and sellers, showing what traders are thinking and doing, their fears and their greed, all reflected in the shapes and patterns of the candlesticks. Mastering this skill helps you spot opportunities that others might miss, giving you a crucial advantage, and manage risk more effectively, protecting your capital and minimizing potential losses. No jargon, just clear step-by-step guidance, making complex concepts easy to understand. By the end, you'll turn those red and green bars into smart decisions informed by a deep understanding of market dynamics. Let's dive in and unlock candlestick charts together, transforming you from a novice into a confident and informed crypto trader. Let's break down a candlestick. Each candle has two main parts, the body and the wicks. The body shows where the price opened and closed in a given period. Long body, big price move. Short body, not much action. Wicks, those thin lines, show the highest and lowest prices reached. The top of the upper wick is the peak, the bottom of the lower wick is the low. Color matters. Green means price closed higher, bullish. Red means it closed lower, bearish. For green, the bottom of the body is the open, top is the close. For red, it's the opposite. Just by glancing at the color and shape, you know who won the battle. Buyers or sellers, that's the anatomy of a candlestick. Now let's read a single candle. Picture a long green candle on Ethereum's daily chart. The bottom of the body is the open, the top is the close, price went up. A long upper wick, buyers pushed the price up but sellers knocked it back before close. A long lower wick, sellers tried to drag it down, but buyers fought back. For a red candle, it's reversed. Top is open, bottom is close. Price dropped. Long lower wick on red, sellers pushed hard but buyers bought the dip. The body and wicks together reveal the day's trading psychology. It's a deeper story than any line chart can tell. That's how you read a single candlestick. Now that we've covered the fundamentals of candlestick charts, let's delve into some of the most common and reliable patterns that traders use to anticipate market movements. These patterns can provide valuable insights into potential buying and selling opportunities. Let's spot simple patterns that frequently appear on crypto charts. Recognizing these patterns can significantly improve your trading strategy. Bullish engulfing, a powerful signal of a potential upward trend. It starts with a small red candle, indicating a period of selling pressure, then a big green one that completely covers the previous red candle. This is key. This engulfing action suggests that buyers are stepping in with force, taking control of the market. An uptrend may be imminent, so keep an eye out. Hammer, another bullish pattern to watch for. It's characterized by a short body at the top of the trading range and a long lower wick extending downwards, a distinctive shape. The long lower wick shows that sellers initially drove the price down, but buyers stepped in and reversed it, pushing the price back up towards the opening level. Often signals a potential bottom in the market, suggesting a possible price reversal. Bearish engulfing, the opposite of the bullish engulfing, signaling a potential downtrend. This pattern features a small green candle indicating initial buying pressure, then a big red one that completely swallows the green candle, a sign of strong bearish momentum. This indicates that sellers are taking over and a downtrend may soon follow. Be prepared for potential price declines. Shooting star, a bearish reversal pattern that appears after an uptrend. It has a small body at the bottom of the trading range and a long upper wick extending upwards, resembling a shooting star. The long upper wick shows that buyers initially tried to push the price up, but sellers quickly slammed it down, rejecting the higher price levels. This often signals a potential top in the market, suggesting a possible price reversal to the downside. These patterns are most effective and strongest when they appear at key turning points in the market, such as at established support or resistance levels. They are less reliable and should be viewed with skepticism if they occur in the middle of random price action or during periods of consolidation. Accurately spotting these patterns and understanding their implications gives you a real edge in the market. By learning these basic candlestick patterns, you'll start to develop a better understanding of market sentiment and potentially anticipate the market's next move. Remember that these patterns are clues, providing insights into potential market movements, but they are not guarantees of future price action. Use them wisely in conjunction with other technical indicators and risk management strategies for informed and successful trading decisions. Alright, let's solidify our understanding by putting this into practice. We're going to walk through some real-world examples on actual crypto charts. This is where the theory meets reality, and you'll start to see how these patterns play out in live trading scenarios. Looking at a recent Bitcoin chart, we can observe a defined downtrend. Notice how the price has been consistently making lower highs and lower lows, indicating sustained selling pressure. Then, a candle with a tiny body and a long lower wick appeared, a classic hammer. This particular formation is hinting at a potential shift in momentum. Initially, sellers attempted to further dump the price, pushing it down to new lows. However, buyers aggressively stepped in, absorbing the selling pressure, and a rally subsequently followed, confirming the hammer's signal. Now let's switch gears and examine Ethereum. After a steady climb characterized by consistent upward movement, a small green candle was immediately followed by a huge red one, a textbook bearish engulfing pattern. This is a strong sign of a potential reversal. That signaled that the preceding rally was likely over, and indeed the price experienced a significant drop soon after the pattern's formation. Remember, context always matters. Candlestick patterns are most powerful and reliable when they appear at key support or resistance levels, or after significant price movements. Therefore, don't just hunt for patterns in random spots on the chart. Instead, look for them specifically at potential turning points in the market. Now, for your homework, take some time to check your favorite crypto charts and altcoin charts, see if you can identify any hammer patterns or perhaps shooting star formations, and don't forget to look for bullish or bearish engulfing patterns. Then, analyze what happened to the price action in the period immediately following the appearance of each pattern. Diligently practicing this exercise will significantly train your eyes to recognize these patterns quickly and accurately, and it will build your confidence in using them as part of your trading strategy. Remember, the more you actively look for and analyze these patterns, the better you'll become at interpreting them and anticipating potential market movements. Let's avoid common mistakes. Don't rely on a single candle or pattern. Always look for confirmation, like a second strong candle or a spike in volume. Patterns on daily or weekly charts are more reliable than on short time frames. Volume matters. Strong patterns need strong volume to back them up. If you see a bullish engulfing with high volume, that's real conviction. Low volume? Be skeptical. It could be a false signal. Candlestick charts aren't about predicting the future, but about stacking the odds in your favor. Use them for risk management and smarter decisions. Combine candlestick analysis with other tools and a solid plan. That's how you trade like a pro, not a gambler.